Right now, trillions of dollars are pouring into artificial intelligence. Entire data centers are rising across the world. Electricity demand is climbing fast, and some of the biggest companies in history are betting their future on this technology. Yet one question still hangs in the air. Is this the next internet revolution, or one of the largest financial bubbles ever created? It began very simply when AI chat tools suddenly became popular, especially after ChatGPT gained about 100 million users in just 2 months, which shocked big tech companies because nothing had ever grown that fast. So they immediately started investing huge amounts of money to avoid being left behind. Microsoft invested heavily in OpenAI. Google accelerated its own AI products. Amazon funded other AI labs. Investors rushed toward any company mentioning AI, and within a short time, the industry moved from experimentation to massive infrastructure building. This is where the scale becomes serious, because AI doesn't run only on software. It needs expensive computer chips, giant data centers, electricity, cooling systems, land, and constant upgrades. And building all this costs trillions of dollars over time. To picture this easily, think about building a huge highway network before knowing exactly how many cars will use it. The hope is future traffic will justify today's spending. But until that happens, the cost remains heavy. Now comes the confusing part many people miss. Some companies investing in AI are not consistently profitable from AI itself yet, meaning they spend more money building the system than they currently earn from using it. So future revenue is expected, but not guaranteed. Another interesting piece is how money sometimes circulates inside the same ecosystem. For example, a chip company invests in an AI firm. That firm buys chips from the same company. Cloud providers finance infrastructure using those chips. Revenue looks strong across everyone's reports, but the companies become financially linked to each other. Supporters say this creates stability and strong supply chains. Critics say it can hide real risk because if one major player struggles, the effect can spread quickly through connected companies. At the same time, physical infrastructure keeps expanding. New data centers are being built, electricity demand is rising, construction companies and utilities are benefiting, but these facilities require continuous upgrades because technology changes fast, so the spending rarely stops. Unlike past tech bubbles, much of today's AI funding comes from profitable tech giants with large cash reserves, companies earning billions from advertising, cloud services, and software, so they can afford heavy investment even if profits from AI take time. Their biggest fear is not losing money now, it's missing the next major computing platform, because history shows companies that ignore new technology often disappear. Some analysts, therefore, describe AI not as a typical bubble, but as a capital black hole, meaning once money goes into data centers and hardware, it stays locked there for years. Assets are hard to resell, and financial stress may appear slowly instead of suddenly. This connects directly to the wider economy because AI investment now influences stock markets, retirement funds, credit markets, and national growth figures. So any slowdown could affect more than just tech companies. There are also everyday impacts people don't always notice: higher electricity demand, water use for cooling data centers, tax incentives affecting public budgets, temporary construction jobs but fewer permanent roles afterward, while workers worry about job automation even though clear productivity gains are still uneven. Despite these risks, the boom continues, mainly because funding hasn't stopped. Governments support AI development, big companies keep investing aggressively, and global competition makes stepping back feel dangerous. Looking ahead, 3 broad outcomes are possible. One where AI delivers major productivity gains and justifies the spending. Another where overinvestment leads to financial strain and unused infrastructure. And a middle path where spending continues, profits take longer, weaker companies fade, and stronger players dominate. So what we're seeing isn't simply hype, and it isn't guaranteed stability either. It's a massive technological shift combined with huge financial bets, real infrastructure growth, and concentrated economic power. And the final result depends on one crucial factor:
whether real productivity and sustainable revenue eventually catch up with the trillions already invested. Because until that happens, the entire system keeps moving forward on capital, confidence, and the quiet fear of missing the future.